Welcome to the MUFG Global Markets Podcast. I'm John Cook, and I'm joined today by Takahiro Sekido, Chief Japan Strategist for MUFG. It's Monday, January 23rd, 2023. Welcome back to the podcast, Sekido-san.
Good to be back.
Always good to have you. So as you know, the U.S. Treasury released the TIC data last week in an effort to set the stage for how the market was positioned heading into the fireworks that ensued following the very unexpected policy changes announced at the December meeting. What does the November TIC data tell us?
U.S. Department of Treasury International Capital USTIC data released on January 18th showed that Japanese investors unloaded U.S. Treasury at a faster pace by $20 billion in November versus $14 billion in October, and net sold a small amount of U.S. stocks by $834 million. In contrast, Japanese investors acquired a net $602 million U.S. government agency bonds and $445 million U.S. corporate bonds. Japanese investors dumped U.S. treasuries very actively in October and November.
Yeah, and as you know, you've made the point, before, Japanese investors, sort of net selling of foreign bonds, just in 2022 in general is pretty impressive, and certainly we've seen a trend of them being net sellers of treasuries versus adding spread products. So that all kind of makes sense. So investors were Japanese investors were maybe not positioned short treasuries, but certainly had a more reduced long heading into that December meeting. So let's keep on going here. So we also got recent data from the JSDA. That data is from December, so it's more recent. So I guess what I'm curious about is what that data shows about how Japanese investors as well as foreign investors reacted to the December BoJ meeting. And obviously, since it's JSDA data, we're talking about how they reacted in the JGB market.
In December, foreigners unloaded 733 billion yen medium-term JGBs and 2.4 trillion yen long-term JGBs after buying 898 billion yen and 1 trillion yen in November. They were buyers of 232 billion yen super long JGBs and 21 trillion yen TDBs, resulted in overall the net buying of 18 trillion yen JGBs, showing that foreign demand was overwhelmingly concentrated in a front end. Amongst Japanese investors, Citibanks unloaded a net 2.6 trillion yen, while the pension fund trust banks bought a net 1.3 trillion yen.
Okay, so foreigners sold, obviously aside from parking cash in the front end, maybe there's some arbitrage trading there, and Japanese investors also net sold. So very, very both. So everyone sort of net sold JGBs, yes, on balance in December. So I guess in the context of that, what should investors be watching for? Again, in the wake of that selling in November, in the wake of that selling in December, as well as in the context of the more recent decision to bolster pooled collateral fund supplying operations by the BoJ.
In December, foreigners responded to the BoJ's surprise monetary policy decision by cutting their holdings of medium to long-term JGB holdings. Foreigners unloaded a sizable amount of 10-year JGBs. But what was interesting was that Japanese investors matched their pace of selling. Yen rates have declined following the BoJ's January meeting because of the short coupling of JGBs. We suspect that both foreigners and Japanese investors have been short covering JGB positions. On January 19th, dollar-denominated G10 bond yield fully hedged, full maturity basis for the currency risk stood at 3.46% for U.S. Treasuries, 3.42% for JGBs, 3.42% for French govies, 3.22% for UK govies. The attraction of yen basis arbitrage trading amongst foreigners during Abenomics has clearly changed. Previously, dollar coupon JGBs were cheaper and more attractive than US Treasuries, but presently expensive. The battleground for foreigners' JGB arbitrage has shifted to the yen yield curve. Hedge funds are main players. While some unexpected TDB arbitrage trading still lingers, this will likely shift in line with the change in the market structure, including the foreigners' JGB bond holding ratio and investor preference in the JGB primary market. On January 18th, yen rates declined after the BOJ announced the changes to its pooled collateral fund supply operations. We think the BOJ will use this tool operations to control the yen swap spread and the yen swap yield curve and upward stresses grown on yen swap rates. Going forward, we think investors should be carefully watching for changes in first, the response by yen swap rates to pooled collateral operations, and secondly, Tokyo market structure, Japanese and the foreign investors' active segments and the trading styles. The December securities flow data suggested that recent changes to arbitrage trading opportunities in the Tokyo market will clearly continue under the next BOJ leadership and Prime Minister Kishida's new style of capitalism.
Yeah, so these pooled, collateral operation or pooled collateral fund supplying operations are key. In fact, on the 23rd, which in 23rd yes. in the Bank of Japan, did its first operation. As I recall, they offered 1 trillion yen of loans for 5 years, and they had interest for a little bit over 3 trillion, and they offered the funds at 11 basis points, which was pretty close to. And I think, if I'm not mistaken, the 5-year bond yield there was 16 basis points. So this is a very interesting and creative way for the Bank of Japan to control JGBs without having to purchase them. But also investors can use these fund supplying operations and borrow funds, post collateral, deposit money at the BOJ, and also receive in JPY rate. So a very elegant sort of solution to a very difficult challenge that the BOJ kind of put themselves in, following the December meeting. You also make this point how the opportunity for arbitrage has changed. For so many years, Bank of Japan monetary policy was just so easy. The juice was in buying JGBs on cross-currency asset swap, primarily in the front end of the curve, and now the arbitrage is really more in arbitraging the yield curve itself. So really a lot of really good points there. We could probably spend multiple podcast episodes discussing them, but alas, we don't have that sort of time. So why don't we wrap things up with your outlook across yen rate, spot dollar yen, and yen basis markets?
The BOJ stayed the course on monetary policy at its January meeting last week, and our yen weakened, but dollar yen quickly shifted gears, and the yen took on a strengthening tone. It is a Lunar New Year for Asian markets, and Asian trading will be quite slow, but Japan remains open with the Diet convening on ordinary session, and we expect the Japanese investors to be active. Japanese trading data shows that the country's trade deficit hit a record high of the 19 trillion yen. The country is importing huge amounts of energy resources, but exporters flows are by no means weak, especially for the automobile sectors. And yen buying by exporters are well mixed, with yen selling by Japanese investors, resulting in a neutral impact. We see a neutral bias for dollar yen, with trading in a 3 yen range between 127 to 130. The yen swap rate curve started to fall after the BOJ's January monetary policy board meeting. Pooled collateral fund supply operations have been very strong, and the yen, the 10-year rates have fallen below the 0.50% in line with the downward trend. We expect a 40-year JGB auction on January 26th to go smoothly, supported by the pooled collateral fund supply operations and affluent yen funds. Over the near term, the BOJ's pooled collateral fund supply operations will provide a strong support, causing the front end through the belly of the JGB yield curve to be stable. We expect the yen rates to maintain a downward bias, although the long end of the JGB yield curve could steepen slightly. The yen base curve has widened after the BOJ's meeting. The Ministry of Finance weekly data shows that the Japanese investors net bought 1.8 trillion yen of foreign securities in the week of January 8th to 14th. This included net buying by 1.2 trillion yen of medium to long-term foreign bonds, 491 billion yen of foreign stocks and investment fund holdings, and 143 billion yen of short-term foreign bonds. Japanese investors, flush with funds, have been rebuilding their foreign bonds and stocks positions so far in January 2023 in the wake of the BOJ's surprise decision last month. Also, over the same week, foreigners net bought 2.38 trillion yen of short-term yen bonds and 185 billion yen of Japan stocks and investment fund holdings, while unloading a net 3.8 trillion yen of medium to long-term yen bonds, which also supported the yen basis widening. Foreigners have been actively unloading medium to long-term JGBs. We see the yen basis maintaining widening bias.
All right, so let's see here. So in FX, you are neutral on dollar yen. In rates, you're bullish JGBs, so you have a downward bias on yen rate. Although you point out that the JGB yield curve could steepen, and it obviously has today's price action is a good example of that. And that's happening as you point out earlier, that both foreign and Japanese investors are covering shorts, and then you have a wider bias on cross currency basis as Japanese investors purchase foreign bonds and foreign purchasing, it goes the other way. So really great episode. Sekido on a ton of great points, and I suspect we'll be discussing similar in upcoming episodes as well. So thanks again for joining us.
Thank you so much for having me, John.
And thank you for listening to the MUFG Global Markets Podcast. Rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And reach out to your MUFG sales rep for any further information. Check back soon for more insights from the Global Markets Research Team.